In today's video, we are breaking down a powerful and timely market message from Tom Lee, the head of research and chief investment officer at Fundstrat Capital. Tom Lee recently joined CNBC to discuss several major developments that investors need to pay attention to right now, including the Federal Reserve Chair decision, the sudden pullback in gold and silver, and what ongoing market rotation could mean for stocks moving forward. Most importantly, Tom Lee explains what typically happens right before the next major market rally, and why this current period may not be as bearish as it feels on the surface. I'm going to play the clip of Tom Lee from CNBC so you can hear his exact words and understand the context behind his comments. Once we watch that together, I will come back and give you my own reaction and breakdown of what he said, including where I agree, where I am more cautious, and what I think investors should really take away from this interview. After that, I am also going to walk you through a deep dive on one underrated artificial intelligence stock that I believe is worth buying and holding for the long term, especially in the type of market environment Tom Lee is describing. If you find value in this kind of market breakdown, hit the like button, share it with anyone who is trying to make sense of this market, and leave your thoughts in the comments below. Subscribe to the channel so you do not miss what comes next. Now let's hear what Tom Lee has to say.
What do you make of the very trades that I highlighted at the very top of this show? Because it's so dramatic. Silver's rollover today, as was the run-up that we've seen.
Yeah, well, I think it is a good choice for Fed share, and the move in gold and silver today, it's an interruption. So clearly the market is rethinking the implications of a new Fed chair. I think the timing was a surprise because it all kind of came out last night, and I think it's very healthy, actually, for silver and gold to be seeing some profit taking, because that was a juggernaut trade that I think in many ways was like a vortex sucking risk appetite from everything else into those two trades.
You think those two trades are done? I mean, you talk almost as if you think this is merely a pause that might refresh. The velocity of the move out of silver today is somewhat startling to look at. The market's not supposed to act that way.
Yeah.
I don't care what happened back in 1980 or whatever. It's not supposed to do this.
That's right. I think there is some fundamental reasons for silver to be rising, and gold is, of course, now should hold a place in someone's portfolio. But those were parabolic moves. I think you're right, that could look like blow-off tops similar to 79.80. We won't know with the fullness of time.
Okay, Professor, what do you make of those trades? We often talk so heavily about stocks, and we will. But these are the moves that have grabbed everyone's attention. Gold, silver, dollar, probably find a few other things too.
I agree with Tom. When you have so many momentum players that join gold and silver, just playing that trend, this is exactly the type of reaction you get, that parabolic move down, and then any little piece of news or little selling, and maybe just the confidence, hey, Warsha's not going to debase the currency, that's enough to trigger this sort of reaction. This could be the high for quite a while, but I still think that, I agree that, having a sliver of gold or some gold in your portfolio is probably still a good idea. I mean, it is a good counter-cyclical asset. It does diversify against risk assets. Okay,
so Tom, your call on the market has consistently been that you think we're going to have what you describe as a three-phase market. You have great start to the year, and in all respects, we've seen that. We've hit record highs this week again on the S&P. You're going to get a drawdown. You've even used the words bear market, and then we're going to get a nice ramp into year-end that you think can get us to 7,700 by the end of the year on the S&P. Explain.
Well, it has been a good start, and as you know, many people kind of follow what markets do in January because that sets the tone for the year, and we're on a positive start. Plus the first week was positive. It's a good omen. So I actually think our 7,700 is probably low. I think the S&P could maybe even do 8,000. We're not sure. But we also know that there's a few things that need to be digested. 3 years of good gains. A lot of good news is priced in. There could be a policy shock. There's been a lot more, and maybe part of it is the White House picking winners and losers in front of the midterms. And the third is that we have a new Fed that the market is going to test. And I mean, today's a taste of it, right? That we have an announcement of it, and the market's already picking winners and losers among commodities or assets or dollar. So I think those can contribute to a drawdown. Last year, it was a policy shock that took us down 20%.
Professor, how does that summation from student Lee sound?
Yeah. Tom is gutsier than I am in making short-term predictions. He has actually a fairly good record. I would like his opinion. I mean, we do see rotation. I mean, the AI phenomenon is magical. Might this be the first year in 3 years where we see the other 493 stocks outperform or not? I'm calling. I wouldn't be surprised if the S&P only did 5 to 10% this year, but the non-Mag 7, the rest did 10 to 15 or even more. It's really hard to say when that might come, and AI is still booming, but I think. I would like to know his opinion. Is there more competition, more doubts about adoption, more fear that there could be a technological breakthrough that might penetrate some of the moats of these great stocks?
Do you want to answer that? Because you're pretty bullish, these names.
Yeah. Well, one, all of them are linked to the importance of AI, and as the tentacles in AI grows, they all benefit. I think a lot of the progress in AI is invisible at the moment. That's why markets are kind of questioning things like what Microsoft reported. But I think that those invisible gains then lead to productivity. But it's at the same breath, this year, I think the market is broadening because we've seen a lot of other trades work besides the Mag 7. And it's not a bad thing. I mean, that to me is not late cycle. A broadening of the market is as a mid-cycle phenomenon, right? Because basic materials are doing well, small caps are doing well, a lot of industrials and healthcare. So that's a sign of a broader market, which is the other 493.
It's a sign, I guess, Professor, of what some would describe as a run-it-hot economy. That is a run-it-hot stock market, and all those cyclical areas are the ones that would do well. Now, normally after we would get a few of the mega cap earnings reports, I would ask you, well, what did we learn about the mega cap stocks this week? But I don't think we learned anything, because I think the group shouldn't be discussed anymore as a group. And we learned whatever we did about Microsoft, and we learned something different about Meta, and thus the stocks reacted differently.
I've never seen the Mag 7 react so differently. They usually just go together, and we think of them as a group. But continuing on what Tom said, I mean, really only 15 to 20% of firms have really even begun to use the potential of AI. And I mean, those are the ones that I think really have a great opportunity to really raise their profits. And we might see layoffs, et cetera, and so on. But that's part of cost cutting in a technological boom. And that's why I think in some way they have the potential to outperform the Mag 7 this year. When you start out at 17, 18 times earnings, you don't need much above expectations at all to really have a good move with a profit increase.
Let's talk about earnings real quick before I let you go. We start out with the shrimp cocktail. The bank started out, and then we get the meat potatoes, and we're starting to get the entrees, like the companies that really, really matter. Estimates are high. We're exceeding them to this point. What's interesting to me is the price action has not necessarily matched the reporting. Reports good, price action not so much, even among those that have done well, Meta excluded.
Yeah, the numbers played out. If you compare this quarter versus last quarter, companies that are beating are rising a lot less. Basically 0.5% now, 5-day gain versus 2% last quarter. But the ones that missed were falling 5.5% last quarter. They're falling 3%. So the market is almost taking the edge off on earnings results. But I think you did point something out that's true. I think it's the first time ever that Meta and Microsoft had a divergent move. They've almost always moved directly on the same day, and one was down 11%, one was up 11%. Or I'm getting the numbers wrong, but
your point's well made.
That's like a 3 or 4 standard deviation divergence.
Coming out of this interview, the first major theme was the market's reaction to the appointment of a new Federal Reserve chair. Both guests clearly viewed the pick as a stabilizing force rather than a political yes man. The immediate reaction in the dollar was telling. The dollar strengthened, which signals that global investors felt reassured that monetary policy would not suddenly turn reckless. From my perspective, that reaction alone tells you how much credibility matters at the Fed. Markets are not just reacting to interest rates, they are reacting to trust. When traders believe the central bank will protect the integrity of the currency, capital flows behave very differently. That is why the dollar jumping was such an important signal, even more than what happened in stocks that day. That credibility also fed directly into what we saw in gold and silver. Tom Lee framed the sharp pullback as an interruption, rather than the end of the trade. And I actually think that framing is important. Gold and silver had become almost one-directional trades, especially silver, which was moving in a way that felt more emotional than analytical. When you see parabolic price action like that, it tends to pull capital away from everything else. In that sense, I agree with Tom that some profit-taking was healthy. Markets need to breathe. When too much money piles into a single narrative, it often ends badly in the short term. At the same time, I also understand why people were shaken by the speed of the drop. Silver does not usually move like that unless something structural is happening. While Tom acknowledged the risk of a blow-off top similar to what we saw decades ago, he stopped short of calling the trade dead. Personally, I think this is where nuance matters. Gold and silver still make sense as portfolio hedges, but treating them like momentum rockets is dangerous. I lean toward the idea that we may have seen a medium-term top, not because the long-term thesis is broken, but because positioning simply got too crowded. That naturally led into the broader market outlook, where Tom Lee laid out his three-phase market thesis: strong start, meaningful drawdown, then a powerful rally into year-end. This is classic Tom Lee. He is willing to make bold forecasts, and to be fair, his track record earns him the right to do that. He pointed out that January strength often sets the tone for the year, and from that angle, his optimism makes sense. But what stood out to me was his acknowledgement that a drawdown is likely not because the economy is weak, but because there are several uncertainties that markets still need to digest. Those uncertainties are not trivial: policy shocks, political decisions that create winners and losers, and the market testing a new Fed leadership team are all legitimate reasons for volatility. We saw an example of that immediately with commodities reacting to the Fed news. From my point of view, this reinforces an important idea. Volatility does not always mean something is wrong. Sometimes it simply means the market is repricing risk in real time. Where I become more cautious than Tom is on the magnitude of the upside. He floated numbers like 7,700 or even 8,000 on the S&P. Could it happen? Yes. But I think investors need to understand that those levels assume earnings execution stays strong and policy mistakes are limited. That is a lot to ask for in a single year. I am not bearish, but I am more selective about where that upside comes from. That selectivity ties directly into the conversation about market rotation and the so-called Magnificent Seven. One of the most interesting observations in this interview was how differently those stocks reacted to earnings. Historically, they have traded almost as a single unit. This time, they did not. Microsoft and Meta moving in opposite directions on earnings is not normal behavior for that group. That tells me the market is no longer buying the AI story as a blanket trade. Investors are now demanding proof, execution, and clarity on monetization. Tom Lee made a strong point that much of AI's progress is still invisible. Productivity gains take time to show up in reported numbers. I agree with that. Technology adoption often looks underwhelming in the early innings because the benefits are diffused and not immediately measurable. However, I also think the market is right to start asking tougher questions. At some point, invisible gains need to become visible profits. Faith alone cannot support trillion-dollar valuations forever. The professor's point about the other 493 stocks was also critical. If this is the year when leadership broadens, that is actually a healthy sign. Small caps, materials, industrials, and healthcare performing well suggests the economy is not narrowly dependent on a few tech giants. I personally see this as one of the most constructive signals in the interview. Broadening participation usually happens in mid-cycle expansions, not at market peaks. That does not mean there will be no corrections, but it does suggest resilience. When the discussion shifted to earnings, the tone became more measured. Yes, companies are beating estimates, but price reactions have been muted. That tells you expectations are already high. The market is no longer rewarding good news the way it used to, but it is also punishing bad news less severely. To me, that feels like a market that is confident, but cautious. It is no longer euphoric, but it is not fearful either. The divergence between earnings results and stock reactions is something investors need to pay attention to. It means that simply beating estimates is not enough anymore. Guidance, margins, and forward visibility matter more than ever, and I agree strongly with the idea that multiple expansion is largely behind us, at least for the biggest names. From here, returns have to come from real earnings growth. The final takeaway that stood out to me was the forward-looking optimism about 2026. Assuming we get through policy uncertainty, trade issues, and government dysfunction, the setup for the following year could be very strong. I think that optimism is reasonable, but it comes with a caveat. the path to that outcome will not be smooth. Investors who expect straight-line gains are likely to be disappointed. Overall, what this interview really highlighted is a market in transition. Leadership is shifting, narratives are being tested, and investors are becoming more discerning. I personally find that encouraging. Markets tend to be most dangerous when everyone agrees, and least dangerous when debate returns. And right now, debate is clearly back. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the one underrated AI stock to buy and hold for 10 years. The company at the heart of this story is Fiverr, ticker FVRR. Fiverr is a global online marketplace connecting freelancers with businesses needing digital services. Its disruptive idea: any digital service could be bought or sold, starting at just $5. This lowered the barrier for both buyers and sellers. Fiverr provides the storefront, payment, communication, and trust, making millions of transactions seamless. It's turned hiring a freelancer into a streamlined e-commerce experience. Freelancers become entrepreneurs, packaging and marketing their skills to a global audience. Businesses, especially small ones, gain agility and access to expertise without full-time hires. Fiverr is more than a tech company. It's a backbone of the modern economy. As flexible work grows, Fiverr's role becomes even more essential. Its long-term potential is far greater than most realize. The AI boom is transforming industries, but for most small businesses, it feels out of reach. Fiverr bridges this gap, not by building AI, but by creating a marketplace for AI skills. Freelancers offer services like AI-generated art, chatbots, and automation, making advanced tech accessible. Demand is exploding. Searches for AI services on Fiverr have skyrocketed. Businesses turn to Fiverr's freelancers as guides and implementers in the AI landscape. Fiverr is selling the shovels in the AI gold rush, profiting from the ecosystem's growth. Every new AI tool creates new service categories on the platform. Fiverr is the human interface for the AI economy, translating tech into business solutions. That's what makes it a unique and powerful AI play. The strongest business advantages are often invisible, like Fiverr's network effect. As more businesses join, more freelancers are attracted, and vice versa. This self-reinforcing loop makes the platform more valuable with every user. Each new participant strengthens the network, creating a formidable barrier to entry. Competitors face the classic chicken and egg problem. Buyers need sellers, sellers need buyers. Fiverr's global brand and active community are years in the making. Its moat deepens with every transaction, giving it pricing power and resilience. Others may compete on features, but Fiverr's strength is its community and scale. This organic advantage can't be easily copied. For investors, it's the kind of compounding edge that drives long-term growth. While many tech companies chase growth at any cost, Fiverr chose financial discipline. After pandemic hypergrowth, Fiverr refocused, streamlining operations and cutting costs. The result: a shift from cash burning to consistent profitability. Profitability means independence from external capital and the ability to reinvest in growth. This discipline shows a mature management team building for the long term. Fiverr's strong balance sheet and positive cash flow are rare in the gig economy. The company currently carries a market capitalization of about $618.62 million, which firmly places it in the small cap category, but that also means it has far more room to grow compared to larger, fully priced tech names. Fiverr is trading at a price-to-earnings ratio of roughly 28.39, which suggests the market is valuing it as a growth company but not in an overly euphoric way. Earnings per share stand at $0.59, showing that the company is not just generating revenue, but is also consistently profitable. That profitability matters, especially in a market environment where investors are far more selective and less forgiving toward unprofitable growth companies. In 2024, Fiverr generated revenue of approximately $391.48 million, reflecting steady demand for freelance digital services across design, marketing, programming, and creative work. Even more importantly, the company reported net income of about $18.24 million, reinforcing the idea that this is a business capable of converting revenue into real earnings. Taken together, these numbers paint a picture of a company that has established a durable platform, achieved profitability, and is operating at a scale where even modest growth can have a meaningful impact on earnings. For investors looking at smaller tech companies with real cash flow and a clear business model, Fiverr stands out as a name that deserves closer attention. This combination of market opportunity, moat, and profitability is powerful. Fiverr has emerged stronger and better positioned for the future. Disciplined execution is central to its investment case. Fiverr isn't playing in a niche, it's targeting a $247 billion global freelance market. This market is vast, dynamic, and rapidly evolving, encompassing millions of freelancers and businesses across every continent. From graphic designers in New York to software developers in Bangalore, the freelance economy is a truly global phenomenon, connecting talent and opportunity in ways that were unimaginable just a decade ago. Fiverr's platform acts as a digital bridge, making it easier than ever for businesses of all sizes to tap into this enormous pool of skilled professionals. Despite this massive opportunity, Fiverr's current revenue is less than 0.25% of the total market. That's a tiny sliver of a gigantic pie, highlighting just how much room there is to grow. The company is still in the early stages of capturing its share, and the potential upside is enormous. The runway for growth is immense. With so much of the market still untapped, Fiverr has the potential to scale far beyond its current size. The journey ahead is long, but the path is wide open. Capturing just 2% of the market could mean nearly $5 billion in revenue, a tenfold increase from where Fiverr stands today. That's the kind of growth that can transform a company and redefine an entire industry. This explosive growth is being fueled by two unstoppable megatrends: the rise of the gig economy and the digitization of small businesses. More people are choosing flexible, independent work, and more companies are embracing digital solutions to stay competitive. The desire for flexible work arrangements is stronger than ever, and businesses are increasingly seeking on-demand talent to meet their needs. This shift is reshaping how work gets done, making platforms like Fiverr essential. What we're witnessing is a structural shift in the global workforce, not just a passing trend. The way people work and the way businesses operate are fundamentally changing. Fiverr sits at the intersection of these powerful forces, perfectly positioned to benefit as the world moves toward more flexible, digital-first work models. The beauty of Fiverr's position is that it doesn't need to invent the market. It simply needs to keep executing its strategy and capturing more share as the freelance economy expands. The opportunity ahead is simply too large to ignore. As the freelance market continues to grow, so does Fiverr's potential to become a dominant force in the industry. With disciplined execution, relentless innovation, and a clear vision, Fiverr's future is incredibly bright. The company is poised to ride the wave of change and shape the future of work. The scale of what's possible here is staggering. Fiverr's journey is just beginning, and the possibilities are as vast as the market itself. Despite strong fundamentals, Fiverr's stock has lagged since its pandemic surge. Wall Street is focused on slowing growth rates, missing the bigger picture. The business has become stronger, profitable, with a deepening network effect and a key role in the AI revolution. The market is valuing Fiverr as a simple gig platform, not as critical infrastructure for AI adoption. This disconnect creates opportunity for long-term investors. The hype has moved on, but the business is quietly executing. For those who look beyond the next quarter, Fiverr is a classic value play. It's the quiet engine of the future of work, before the market catches on. The next decade will bring unpredictable change, but some business models endure. Fiverr is built on the timeless need for talent and meaningful work, powered by a compounding network effect. It's not about a single technology, but enabling an entire revolution, adapting to whatever comes next. Its disciplined shift to profitability shows a focus on real, sustainable value. While others chase hype, Fiverr is building the essential infrastructure for tomorrow's economy. This is patient, compounding growth just getting started. The platforms that facilitate the new world of work will thrive for decades. The future belongs to businesses that empower, democratize, and connect. Which models do you believe will shape the future of work, and why? Let me know in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.